Let me ask you something, and I want you to really think about this. You walk into a grocery store today, the same store you've been going to for years. You grab the same box of cereal, the same gallon of milk, the same dozen eggs. Nothing fancy, just your weekly routine. But when you get to the register and look at the total, something feels off. You're sure you bought less than last time, but somehow the number is higher. You check your cart twice. You didn't grab anything extra. So what happened? Or maybe this one hits closer to home. You're filling up your car at the gas station, and you remember the exact price from 3 years ago, almost down to the cent. And now you're paying nearly double. Same gas, same car, same you, but a completely different price. Here's the thing. You're not imagining it, you're not forgetting, and it's not just bad luck. What you're experiencing has a name. It's called inflation. And today, we're going to pull back the curtain on exactly what it is, where it comes from, and, most importantly, what it's quietly doing to your financial future right now, whether you realize it or not. Stick with me for the next 30 minutes, because what I'm about to show you could genuinely change how you think about every dollar in your wallet. Okay, so let's start from the beginning. What actually is inflation? Most people will tell you, oh, inflation just means prices go up. And technically, yes, that's true. But that definition is so surface level that it actually hides what's really going on. Let's go deeper. The real definition of inflation is this. It's the gradual erosion of your purchasing power over time. That means every dollar you hold today is worth slightly less tomorrow. Not because the dollar bill itself changed, it still says $1 on it, but because what that dollar can buy has shrunk. Here's a concrete example. In 2000, a movie ticket in the United States cost about $5.39 on average. Today, in 2026, that same movie ticket costs around $15 to $17 in a standard theater, and that's before you even think about popcorn. So the dollar didn't disappear from your wallet, but its purchasing power? It effectively got cut in half and then some. Stat. The U.S. Bureau of Labor Statistics reports that $100 in 2000 has the purchasing power equivalent of roughly $175 to $180 in 2026, meaning the dollar has lost nearly 45% of its value in just 26 years. Now, here's what most people don't fully grasp. This isn't a bug in the economic system. For a healthy, growing economy, a small amount of inflation, around 2% per year, is actually the target. The Federal Reserve in the United States explicitly aims for 2% annual inflation. Why? Because mild inflation encourages spending, investing, and borrowing. It keeps the economic engine running. The problem is when inflation goes above that comfortable zone. And as we've seen recently, from 2021 through 2023, inflation in the U.S. shot up to levels not seen since the 1980s, hitting over 9% at its peak in June 2022. That's when people really started to feel the squeeze. Think of inflation like a slow leak in a tire. At 2%, you barely notice it. At 9%, you're suddenly stranded on the side of the road. All right, now let's get into the meat of this. Why does inflation actually happen? Economists generally point to 3 main causes, and I want to break each one down in a way that makes total sense. No textbook jargon, just real-world logic. Cause 1, demand pull inflation. Too much money chasing too few goods. Imagine you're at a concert venue that holds 500 people, but 2,000 people all want tickets for the same show. What happens to the ticket price? It skyrockets, not because the concert got better, but because demand massively outstripped supply. That's demand pull inflation in a nutshell. When consumers have more money to spend, whether from stimulus checks, rising wages, or easy credit, they collectively chase the same limited amount of goods and services. Businesses realize they can raise prices because people are willing to pay, and so prices go up. This is exactly what happened in the U.S. during 2020 and 2021. The federal government injected roughly $5 trillion in stimulus and relief funds into the economy. People had money in their pockets. They wanted to spend. But supply chains were still recovering from the pandemic shock. Result? Prices surged across almost every category. Stat: U.S. personal savings rate spiked to nearly 34% in April 2020, the highest ever recorded, meaning Americans were sitting on mountains of unspent cash, ready to flood into the economy the moment restrictions lifted. Cause 2. Cost push inflation, when it costs more to make stuff. That's demand pull inflation, too much money chasing too few goods. Now let's flip the script. Sometimes inflation isn't about consumers having more money. It's about the cost of producing goods and services going up. This is called cost push inflation. Here's a simple way to think about it. Imagine you run a small bakery. Flour, butter, eggs, electricity, the rent on your shop, those are your costs. Now, what happens if the price of wheat skyrockets because of a drought? Your flour costs more. You can either absorb that cost, which means you make less profit, or you pass it on to your customers by raising your prices. Almost every business chooses the second option. The classic example of cost-push inflation was the oil price shocks of the 1970s. In 1973, OPEC, the oil cartel, cut off oil exports to the U.S., causing oil prices to quadruple almost overnight. Because oil is an input in almost everything, transportation, manufacturing, plastics, agriculture, that shock rippled through the entire economy. Inflation hit 12% in the U.S. by 1974. We saw a smaller but very real version of this in 2022, when Russia's invasion of Ukraine disrupted global energy and food supplies, sending energy prices and food prices sharply higher around the world. Here's something most people don't realize. When your energy bill goes up, you don't just pay more for electricity, you pay more for everything because energy is baked into the cost of every product you buy. Cause 3. Built-in inflation, the wage price spiral. This one is the sneakiest and, frankly, the hardest to stop once it gets going. It's called built-in inflation, and it works like this. Workers see that prices are going up, so they demand higher wages to maintain their standard of living. That's completely rational. But when businesses pay higher wages, their costs go up, so they raise their prices to maintain their profit margins. Now prices are even higher, so workers demand even higher wages. And the cycle repeats. Economists call this the wage price spiral, and once it gets embedded in expectations, meaning everyone just assumes prices and wages will keep rising, it becomes almost self-fulfilling. This is actually what the Federal Reserve feared most in 2022 and 2023. That's why they raised interest rates so aggressively. 11 consecutive rate hikes, bringing the federal funds rate from near 0% all the way to over 5%. Stat: in 2023, the Fed's interest rate reached a 22-year high of 5.25 to 5.5%, its most aggressive tightening cycle since the Paul Volcker era in the early 1980s. Now, I want to talk about something that doesn't get nearly enough attention in mainstream conversations about inflation, and that's the role of the money supply. There's a famous quote from the economist Milton Friedman: "Inflation is always and everywhere a monetary phenomenon." What he meant is this: inflation fundamentally happens when there's too much money in circulation relative to the amount of goods and services available. Think about it this way. Imagine a small island economy with 10 people, 10 apples, and $10 of total currency. Each apple costs $1. Now, imagine the island's central bank suddenly prints $10 more, making the total money supply $20. But there are still only 10 apples. What happens? Each apple now costs $2. The apples didn't change, only the money supply did. That's monetary inflation. In the real world, the U.S. Federal Reserve has enormous control over the money supply through a process called quantitative easing, essentially buying assets and injecting money into the financial system. Between 2020 and 2022 alone, the Fed's balance sheet expanded from about $4.2 trillion to nearly $9 trillion. That's an unprecedented injection of liquidity into the U.S. economy. Stat: the USM2 money supply, the broadest measure of money in circulation, grew by approximately 27% between February 2020 and February 2021. That's the largest single-year increase since World War II. Now, I want to be careful here. I'm not saying central banks are evil or that monetary expansion is always wrong. Sometimes, like during the 2008 financial crisis or the COVID-19 pandemic, massive monetary intervention is necessary to prevent economic collapse. The issue is timing and magnitude. When you inject that much money into an economy, inflation tends to follow. It's not a coincidence. Most people think of inflation as prices going up, but a more accurate mental model is inflation is actually the value of money going down. And understanding that distinction changes everything about how you should handle your finances. Okay, let's get into some real numbers, because I think a lot of people understand inflation in theory, but have never actually sat down and calculated what it costs them in dollars and cents. Let's use the rule of 72. This is a classic financial tool. To find out how many years it takes for inflation to cut your purchasing power in half, you divide 72 by the inflation rate. At 2% inflation, the target rate, your money loses half its purchasing power in 36 years. That's manageable. A bit unsettling, but manageable. At 4% inflation, that halving happens in just 18 years. So if you're 30 years old and you have $100,000 sitting in a savings account earning essentially no interest, by the time you're 48, it has the purchasing power of $50,000 today. At 8% inflation, which the U.S. actually experienced in 2022, the halving happens in just 9 years. 9 years. That's not a distant future problem. That's your next car purchase, your kid's college fund, your down payment on a house. If you had $50,000 in a standard savings account in January 2020, earning 0.06% interest, the national average at that time, and inflation averaged 5% per year through 2024, your account would technically show around $51,200. But in real purchasing power terms, that $51,200 would only buy what $41,500 could buy in 2020. You lost nearly $9,000 of real wealth, while the number in your account went up. That's the cruel arithmetic of inflation. The number goes up, but your wealth goes down. This is why financial advisors constantly talk about beating inflation, because just keeping up with it is the bare minimum required to not lose ground. Now, here's the flip side, and this is where it gets interesting. Inflation isn't bad for everyone. Borrowers with fixed-rate loans actually benefit from inflation because they pay back their debt with dollars that are worth less than the dollars they borrowed. If you have a 30-year fixed mortgage at 3% and inflation runs at 6%, you're effectively being paid to borrow money in real terms. Here's the thing most people completely miss. Inflation is a massive hidden tax. It doesn't show up on your paycheck stub. No one sends you a bill. But every year, it quietly extracts real wealth from your savings and transfers it elsewhere. Now, let's talk about the human side of this, the psychology, because this is where it gets really fascinating. One of the most powerful forces in inflation is inflation expectations. Here's what that means. If people believe inflation is going to be high, they behave in ways that make inflation higher. Workers demand bigger raises, businesses raise prices preemptively, landlords increase rents. It becomes a self-fulfilling prophecy. This is why central bank communication, the actual words that Fed Chair Jerome Powell uses in press conferences, moves markets. When he signals confidence that inflation is under control, it literally helps bring inflation down. When he sounds uncertain, it can trigger a spiral. The psychology is that powerful. There's also a cognitive bias called money illusion, the tendency for people to think about money in nominal terms rather than real terms. For example, if you get a 5% raise but inflation is 6%, you actually took a pay cut in real terms. But most people focus on the positive. I got a raise. And that mental error, confusing nominal gains with real gains, causes people to make worse financial decisions. A 2022 survey by the American Psychological Association found that 87% of Americans cited inflation as a significant source of stress, making it the top financial stressor, ahead of debt, housing costs, and job insecurity. There's also the availability heuristic at work. We notice price increases more than price decreases. We remember paying $3.50 for a dozen eggs and feel visceral anger when we see them at $5. But we barely register when some prices stay flat or fall. This asymmetry in perception makes inflation feel even worse than the numbers suggest. All right, let's get practical. Now you might be thinking, this is all fascinating, but what am I actually supposed to do about it? Great question. Here are the most important things you can do right now. Step 1. Don't let cash sit idle. Cash sitting in a low-yield savings account is guaranteed to lose purchasing power to inflation. At minimum, move your emergency fund into a high-yield savings account or a money market fund. As of 2025-2026, you can find accounts yielding 4 to 5% annually, which at least partially keeps pace with recent inflation rates. Step 2. Invest in real assets. Historically, the best inflation hedges have been real assets: stocks, equities in companies that can raise prices, real estate, commodities, and inflation-protected securities, like Treasury Inflation-Protected Securities, or TIPS. The S&P 500 has returned approximately 10% annually on average over the past century, well ahead of inflation's historical average of around 3.3%. Step 3. Understand your debt. If you have fixed-rate debt at low interest rates, like a mortgage locked in at 3%, that debt actually becomes easier to service in an inflationary environment because you're paying back with cheaper dollars. On the flip side, variable-rate debt becomes more dangerous as rates rise. Know the difference. Step 4. Invest in your human capital. The most inflation-proof asset you own is your own earning power, your skills, your education, your professional network. People with in-demand skills can negotiate for wage increases that keep pace with or exceed inflation. People with stagnant skills and no negotiating leverage get their real income eroded every year. According to the Bureau of Labor Statistics, workers who voluntarily changed jobs in 2022 saw wage increases averaging 8 to 10%, while those who stayed in their jobs averaged only 4 to 5%, meaning job switchers actually beat inflation in real terms, while stayers lost ground. Here's what I want to leave you with today. Inflation isn't something that happens to other people in other countries or other times. It is happening to you right now, every single day. The question is whether you're going to be passive about it and watch your purchasing power quietly drain away, or whether you're going to be intentional about fighting back. The people who understand inflation, who truly understand it, not just in theory, but in terms of their own money, they make different decisions. They don't let cash sit idle. They invest in things that retain or grow real value. They're aggressive about earning more. They understand that a safe bank account that earns less than inflation is actually losing them money. Understanding inflation doesn't require a finance degree. It doesn't require a massive portfolio. It requires awareness. And that awareness, that simple shift in how you see money, can be worth thousands, tens of thousands, even hundreds of thousands of dollars over the course of your lifetime. So here's your challenge. This week, look at every dollar you have sitting in cash or low-yield savings. Ask yourself, is this money working hard enough to at least keep up with inflation? If the answer is no, it's time to make a change. The best time to understand inflation was 20 years ago. The second best time is today. If you found this valuable, share it with someone who needs to hear it, because this is the kind of financial literacy that should be taught in school, but usually isn't. And together, we can change that. See you in the next one.